All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Khouri, financial planner, green thumb, husband, and just dad. Approaching the end of the financial year, there are a few things most people are pretty excited about. I say that with a little bit of sarcasm, of course, but let's be honest. Some people will be looking forward to getting a tax refund. Some people dreading a tax bill. Either way, it comes around every year, and it's really important to understand some things that you should be doing and some things that you should probably consider before the financial year ends. I wanted to just touch on a couple of these topics. Now, I'd like to drop the disclaimer that I'm not an accountant. So some of these areas I'm discussing do relate to tax, and it's really important to get the proper tax advice from an accountant that can actually give you that guidance. The first one is to claim all legitimate deductions, and a big part of this relates to having a chat to your accountant. And if you don't have one, find one, ask your friends or advisor who they would recommend, but find an accountant that can give you some guidance to know what you can actually claim and understand what's legitimate and what's not legitimate. And I really do highlight that word legitimate. Just because a friend of yours tells you can claim something, it doesn't mean you actually can. And it's really important to get the right advice and know what it is, because once that deadline passes, you can't claim any things anymore for that financial year if the financial year is over and if you haven't spent them yet. The second thing is to potentially look at prepaying any deductible expenses. Now, this is an accountant question, but there are certain things that you can potentially prepay, and this relates to a business owner and to an individual. The other thing to consider is your super contributions, if you'd like to maximize your super contributions, or if you would like to just make some last minute contributions. There are different types of contributions. It's really important to get the right financial advice. But for a lot of people, especially someone that's older, the window and the time frame to be able to contribute to super usually is shrinking quite quickly. So it's important to take advantage of opportunities if it's the right thing for you. Another thing is to review your investments. Look at your investments and look at which investments potentially could be underperforming. And it may be a good time to realize those losses, and really just look at dividend timing and just understanding a little bit about your investments and what tax liability that they can potentially give you. And knowing this in advance helps a lot. Something I really encourage clients to do is to have a chat with their accountant and do some tax planning just before the year ends. Ideally 2-3 months before the year finishes, but just some planning for the year ahead instead of waiting for that year to start. And there are things you could have done differently. A big part of this as well is checking your private health insurance. Have a look and check. If you have it, maybe get a review of your premiums. But if you don't have it, speak to your accountant as to whether it could be worth having, especially if the Medicare levy surcharge applies to you, which is an extra surcharge that you essentially pay in your tax if you earn over a certain income. Another big one, and this comes down to being proactive, but organize your records, your tax records and receipts and bank statements and pay slips and records of investments and work from home logs. Do all that now. Don't do it at tax time. At tax time, things can get really crazy for you and the accountant, and having this all prepared actually makes it a lot easier when you go in to see your accountant. You've probably noticed your accountant gets busy around tax time, but you'd be surprised how many people actually don't get all their stuff in time fast enough. And sometimes I speak to some accountants who for the first 3-4 weeks of the financial year are not actually that busy because people are still getting their stuff together. So if you can get in early, you've got the opportunity to see your accountant as soon as possible and get your tax done. Another thing worth reviewing is whether your HECS and taxes being withheld properly. Now, this is definitely an accountant question, but reviewing this and making sure it's done properly could minimize the risk of you getting a surprise tax bill at the end of the year. A lot of people just assume that their employees have set it up correctly and that the correct amount of tax and HECS is being withheld every fortnight or month or week or however you get paid. But you'd be very, very surprised where I see some situations where it hasn't really happened and the client does their tax and they come back to me saying that they just got a tax bill, or usually they'd get a refund, but they got nothing because it's sort of offset. One's offset the other. A big one, now this is the financial planner in me, is going to say to you, plan what you're going to do with your tax refund. So if you are going to get a tax refund, plan what you're going to do with it, or if you're going to get a bill, plan how you're going to manage that and how you're going to save up for it. Now, if you're lucky, it's only a couple of $100. In some cases, it could be thousands of dollars. And planning either A, what to do when you get that refund, and talking to your advisor and working out whether you should be paying off debt or putting it into superannuation or putting it towards something, or B, finding out regarding, if there is a bill, how you're going to save up for that, whether it's through budgeting or through compensating in a different area of your expenses to be able to cover that bill, because no one likes paying interest, especially the interest to the tax office, because usually it's higher than some other interest rates. On that note as well, is if you have made a personal super contribution that year and you haven't submitted a notice of intent and you do intend to claim that as a tax deduction, that needs to be addressed. And this is a conversation to have with your financial advisor, just to make sure that this specifically applies if you haven't lodged last year's tax return and you're about to lodge it. Now, depending on the time of the year that you're listening to this episode, what I'm explaining may not apply, but it's really important to understand whether, if you have made a contribution, whether a notice of intent needs to be submitted before your tax return is lodged. This can be an issue, consideration, I should say, before the end of the financial year, if you haven't lodged your tax return for the previous year yet, or for the next financial year when you are lodging that tax return, if you've made any personal super contributions. Another big one, again, and this is the financial planning side of things, is to review your budget, review your subscriptions, expenses, things that you pay. Just take this as an opportunity while you're in money mode. Review your expenses and where you're spending your money. Most people are actually doubling up on a lot of subscriptions, or they're paying for subscriptions that they're not using enough, and they might use it once a year, once a quarter. Is it really worth $30 a month? So it's worth asking yourself these questions and thinking about whether you actually need it. And while you're doing that, why not set some financial goals for the new financial year? If you failed on your New Year's resolution, reset it. You're halfway through the year, and it's a chance to just sit down and be like, all right, you know what? It's April, May, June, whatever it may be. 1st of July, this is what's happening. And I've had a few chats with some clients this week, actually, and they've actually said it to me that, look, 1st of July, I'm going to see that as a new year, and these are the things that I really want to work on. Lastly, you could probably tell the most important thing is to get advice and talk to the right people. Talk to your financial advisor about the things that we can help you with. Talk to an accountant about the things that they can help you with. But most importantly, make sure that you're being careful in the decisions that you're making if you aren't getting advice. And if you are, make sure that you're surrounding yourself with the right people so that they can help you and you can be a bit more proactive, because, as I said, there's one option is to sit back and relax and just go with the flow and just be reactive, or you can be proactive and plan things, get your ducks in a row so that you can make sure tax time is as smooth and as efficient and as rewarding as it possibly could get. Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases, and feel free to share this episode with any friends or family that you think it might benefit. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.